Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, January 4th. I actually put 2024 on here, but it's 2025. And this is the weekly market update. A disclaimer, anything that you hear or see on this video or podcast is not to be taken as investment advice. This is not financial advice. I cannot give individual financial advice. This is for informational purposes only. Please take that into consideration. Do your own work. It's your money. It's your responsibility. Okay, so we're into the new year. Happy New Year for everyone. I hope everybody is prepared for 2025. I think it's going to be very exciting. I think it's going to be volatile. And I think that we're already starting to see manifestations of some different risks, which we'll get into in this particular video. So we start out here, one of the main risks that I'm seeing, and I've stated in a couple of interviews I did recently on for other folks, other channels that interviewed me, in it to win it with Steve Barton and Triangle Investor Lucian. Um, I'm very uh, apprehensive about the valuation levels and the risk and the breadth that exists in the U.S. stock market. It's a classic getting near the end of the move versus being at the beginning of the move. You're seeing all kinds of divergences. You're seeing breadth shrink to a very few stocks. These are not indications that in the past have led to the beginning of a bull market. They are usually what you see at the end of a bull market. Now, having said that, that doesn't mean, as I always caveat and qualify my statements, that doesn't mean it can't go higher. It doesn't mean things can't get more ridiculous. But I think at this point, you're really tempting fate if you're putting new money into these companies. So here's an example from Bank of America. This is the monthly market breadth is on pace to hit an all-time low in December. So, I mean, this goes back to 86. Okay, this is where you're at. This is the percent of stocks outperforming the S&P 500, and it's at basically almost a 40-year low. And I mean, we continue to show these things week after week. They're becoming such outliers now relative to history. I don't know how people can still make the case that, except to be bullish. This is very risky at this point to be entering into the stocks that have performed well for 2 years in a row now, and a lot of it based on the AI hype, if you will. And I go back to what I experienced during the internet bubble. The initial perceived winners or the companies that saw their stocks rise initially during the original internet bubble, they weren't necessarily the long-term performers. A lot of companies, when you have these new technologies, whether it's railroads or canals back in the 1800s or whatever, uh, the initial companies that come into this sector or are darlings don't necessarily end up being the winners. And I think what you have here is you just have a lot of what you have all the time in these cycles, these bubblicious cycles. It's just taken over the greed, the FOMO, the the over exuberance. It is what it is. And um there's a lot of people that have made a lot of money, and that's good. I hope that they keep it. But to think that things are just going to continue upwards uh, indefinitely, I think is not prudent. The other thing that you'll see a lot of folks say is that, well, I'm going to get off before the thing crashes. I know, but that's easier said than done. Uh, don't discount the amount of emotion that gets tied up into this, right? The amount of how the justifications for higher and higher prices and more bubblicious conditions can be. We've seen, anecdote after anecdote of people in various altcoins, or this guy with the Tesla stock that ran up to 485 million and then basically lost it all. So it can happen to anybody, or how I talked about several weeks ago about how Stan Druckenmiller played the internet bubble correctly back in 99, 2000, got out, had tremendous profits, should have went on vacation, made his year, whatever. But as the market, after he sold, the market kept going up, and then he got back in the market against all of his experience, all of his training, all of his knowledge of markets and market history. He just couldn't resist, and he got back in, and he took a big, big loss. And if you ever get a chance to listen to him talk about it, I mean, this is one of the best investors of all time. And even he succumbed to the FOMO and the greed. And so this will eventually resolve itself like all bubbles do in a massive correction with a lot of people getting hurt. And I don't look forward to it. I can't predict it. It's unknowable, like I said. But the chances after 2 years of 20+% gains to have another big up year just doesn't seem the percentage chance of that happening is low. But we'll see. Anything can happen in these markets as we've seen. So here's another indication of breadth. The market is relying on a few stocks to move averages higher. And you see various other times going back to the Depression where we had market cap of the largest stock relative to the 70th percentile stock, weight of the top 10 stocks in the S&P, and you see that various other times where we had peaks in the market where we had breadth consolidate down to a few stocks, and we're back up to times we're back up to a condition of breadth contracting that was similar to right before the stock market crash in 1929. Now, that does not mean we're going to have a stock market crash. I'm just pointing out to you the historical narrative. You see the dot-com bubble that I just talked about. We're past that even. Okay, here's the Nifty 50. I talk about that. So these were major market declines. Okay. And again, the anecdotal evidence, the circumstantial evidence, the historical evidence is aligning against stocks continuing to move higher. Again, that doesn't mean they can't. That's what's so fascinating about these markets. They confound people. This is another reason why, like, for example, why I like baseball, because somebody will always break some kind of record somewhere, some obscure record. And it's the same thing with these markets. They do the maximum amount of confusion to get the maximum amount of people on the wrong side, and then they reverse. And so this is what I find so fascinating about trying to watch markets and trying to understand markets. And that's why I think you can't just do it by the seat of your pants. I think you really need to be a student of the history and look when you see these type of situations developing, then you have to be a little bit more prudent and think to yourself, do I want to commit new capital when I'm, at these levels of overvaluation and with breadth, the stock market moving higher, relying on just a few stocks that usually in the past has not been a recipe for success. That's all I'm pointing out. So here's interesting, this is the market cap of various countries, total market cap, and you see the United States $63.8 trillion. And then you see the various other countries. Here's the developed markets in Europe, 16.4 trillion, China and Hong Kong, 15.7, all the way down to some of these smaller economies where they're not even $1 trillion, the market cap. And, India, for example, it has like pretty decent growth going on there, 4.6 trillion. And so the United States is just such an outlier. And it's just the gravitational pull now of capital into it because the markets have performed so well is this really helps you visualize how out of whack things are, in my view. Now, here's a perfect example. I mean, it's Nvidia's market cap is currently 11.7% of US GDP, $3.29 trillion. Now, obviously, it's a good company. I think they recently reported tremendous earnings growth, sales growth. But is it worth 11.7% of the US GDP? I mean, during the internet bubble, for example, Cisco, which made the routers, because the internet was being built out, you needed all these routers and servers and things, and Cisco was one of the main players, and it was the darling of that. It was kind of the stock that a lot of people gravitated to as the, nuts and bolts of the internet build out. And at one time, it became very overvalued, and it represented something like 5.5% of GDP. And now we have a stock now in this current bubble that's twice that. Okay, so Cisco during the last bubble in the well, not the last bubble, but the tech wreck bubble, uh, that stock was the highest valued stock relative to GDP. Cisco representing about 5.5% or 6% of GDP, and now we have a stock Nvidia that's twice that. And so these are the things that you can ignore them. People do ignore that. There's very few bears left, people that are bearish. I just read an article, Jeremy Grantham, I mentioned him in GMO. He's not really working there full time. He's kind of like just a kind of a chairman emeritus or whatever. But he just got interviewed. He's one of the, and he was pointing some of these things out in the article. And that during the tech wreck, for example, he became bearish as tech ran up in 2000. And GMO lost half of their capital. People pulled half their capital out during that because they said, you're underperforming. And he said, well, that's the price we have to pay. He was lucky because he controlled GMO. And so they didn't succumb to, well, let's just go out and buy the what everybody else is buying so that we can keep assets under management. He had a view, he kept it. It cost them half their capital that they had under management. But once it peaked, which these things always end up blowing up, it's inevitable. Then he pointed out that, the value stocks that he was invested in did tremendously well. If you will go back and look at the tech wreck, when the NASDAQ was down like 80% over the subsequent, whatever it was, year and a half, 2 years after that, I don't remember exact time frame, but value stocks tremendously outperformed. And basically, they recovered. Of course, professional investors, big people that control big money in pension funds and endowments, they're just the same as retail. They go wherever the shiny object is, okay? Because everybody has somebody they have to report to if they're running money in these entities, and you don't want to underperform or you get fired, okay? The advantage we have as having long-term capital that we're stewarding ourselves for our own personal accounts, we are not subjected to an investment committee or oversight by somebody expecting us to do quarter to quarter. Now, obviously, I see my subscriptions and I see, the comments, you know, uh dud service, just follows what other people do, underperform. Yes, we underperformed last year because we're not in the Mag 7, Mag 10. I'm not going to buy overvalued stocks. We don't do that here. And so it gave me a lot of encouragement when I read that article in the recent interview that he gave. I think that we're on the right track here. Um, Again, I'm going to stick to my knitting. I'm going to stick to what has worked for me, what I think works long term. You know, I was down last year relative to the S&P, but I've crushed the S&P over the last 5 years. And I think that I'm willing to trade periods of underperformance in the short term for sticking to what I think has worked, which is selling over valuation and buying undervalued securities. And inevitably over a longer period of time, which is what we're focused on here. This is not a trading service. I don't try to figure out what's going to happen in the next quarter or two. We're talking about multi-year events here that I'm looking at. I That perspective has for me, if you have patience and you know the history, I think that you can in fact uh, d outperform. And that's really what we're trying to do, right? We're trying to build long-term wealth here. If you just want to shoot from the hip and you're a trader and you get off on that, Allah be with you. I hope you do well. I don't have any animosity for people that bought Fartcoin or Nvidia and wrote it up or Tesla or whatever. I have no competence in buying those things. Okay. I don't have enough knowledge to understand all the technology to add anything. I mean, how many people, analysts are following Nvidia? What can I possibly know that they don't know? Okay. So There's no there's no knowledge there. I look for places where, for example, well, I've been talking about Latin America for the last over a year, year and a half, because I could see the political winds changing there. We've done very well in Argentina, even though we had the initial stumble as I got cold feet uh, uh, when the election happened. But we got back on course and we've done well there. I'm looking forward to the elections that are going to happen in Colombia in next May, I believe. And we're right in that window of a year to a year and a half that Druckenmiller says we should be looking at for forward, where we have a government that's a president that has a 23% approval rating and Colombian stocks that have basically done nothing for the last many years. So I think there's an opportunity there. No one talks about that, but I think that's where your opportunity could be. You could have stocks that are there that could double or triple, okay, if you get the right government in there and just that perception change. Those are the things that I look for, or things where they're tremendously undervalued relative to the net asset value, and that there's a management that's trying to close that net asset value gap. Those are the things where I play, okay? And I think that again, you're going to have some short-term volatility because value is always inversely correlated most of the time to growth. And so this is the way things are. But if you're, like I said, as I said on a recent interview that's I had, if you're in here buying these companies now, when you're at these historic overvaluations or at sediment levels that we've seen during previous market peaks, then again, you may get lucky, you may be able to make money, but that's not where I want to play. I don't want to play out in traffic like that and risk getting hit by a car. And I think that's what you're doing if you're doing these things. So here again, U.S. dominates world market cap. We just showed the other chart. You just another way to show it. I think your opportunity here is in emerging markets going forward, maybe over the next decade. Lots of opportunity there. Lots of markets that are beaten down. And we've had, as you see here, 10 or 12 years of outperformance. The U.S. is the largest economy still. It is a good place to do business, even though I believe that it's giving up a lot of its advantages. But you know, the rest of the world's growing too, and there's opportunity elsewhere in the world that's you can buy that opportunity at substantial discount. So here's the US dollar. The strongest is stronger than ever. I mean, this just goes back to 95, showing US dollars divergence from fair value. This was from B of A Global Research. Yeah, there's no doubt the US dollar has been tremendously strong for a while, but I think you have a risk here to this also because it's a lot of it's based on, I think, um, a lot of capital flowing in. Like I pointed out last week, foreigners now own the most U.S. stocks that they've ever owned. You have interest rates that are being cut around the world, but the U.S. has not cut as drastically as other places. So the intermarket relationships tend to lead to higher rates in the U.S. vis-a-vis some of these other countries. So capital flows here. You get some carry trades going where people buy the, U.S. Treasuries on, and they do it on margin with their currency. They're also getting a bump for the dollar stronger relative to their. So you have a lot of capital flows coming into the U.S., but I think a lot of them could be just temporary. If we have, I don't know what the catalyst will be for the bubblicious uh, market to blow up. We never know. It's always in retrospect that you can do the post-mortem. I mean, I can point out different things that I think are risks. Energy prices moving higher this year, which I believe is going to happen. Um, the fact that the U.S. has to basically roll and sell $9 trillion in government debt. That's a risk as rates go higher. I mean, what does the stock market do if the long bond is up at, close to 6%, which I think could happen? So I don't think that's an environment where stocks are going to outperform. So if we see these flows reverse, then what happens to the dollar? Plus the fact that the administration and its America First policies and wanting to bring back manufacturing to the U.S. doesn't make sense to bring manufacturing back to the U.S. if you're trying to compete with these other currencies countries and currencies, and they're debasing their currency, and your currency's strong. You need to, in order to export, you need a weaker currency. At least that's how this incoming administration thinks about it. So how do they get the dollar lowered? There's a bias towards that. So uh, a lot of risk here to, I think, this high dollar. One of the ones, this is from the Peterson Foundation. They do a lot of work about the debt. Federal deficit, put it here, it will continue until it breaks. Federal deficits are projected to be high despite low unemployment. So here you have, just in the up till recently, we're running, the projections from the CBO, it's not John's projections, are 10-year average deficits of 6.3% of GDP. Now, the incoming Treasury Secretary says he wants to get that down to 3% by the end of the Trump administration. That's the goal. Part of that's going to be through deregulation, they're saying. And hopefully, what we're being sold is what the Doge Committee is going to come up with. But as I've said before on several other occasions, I do believe there will be some low-hanging fruit that they can get, but I don't think you're going to cut these deficits like people think. And that's notwithstanding the fact that what happens if you, in fact, do have a recession? What happens if you do have a stock market decline? What happens to tax revenues? They go down in a recession. What happens to mandatory spending? It goes up in a recession. So you could actually see deficits that are higher than projected. I mean, one of the things I pointed out with the CBO is they project, no recession over these time periods in many cases in their projections, and that's just ridiculous. It's inevitable you're going to have a recession and you're going to have a stock market decline at some point, and that's going to affect revenue, right? Plus, if you start getting layoffs and things, you're going to have uh, you know, increased demands for food stamps, Medicaid, unemployment insurance, all these things. So, um, yeah, this is, to me, is not long-term dollar positive. Plus the fact that you have, again, the entitlements are kicking in as the boomers, baby boomers, um, retire, and the fact that these schemes of Social Security and Medicare are not fully funded, contrary to what a lot of people say in the media and in government. They're not. And so the money has to come from somewhere. It will come from the federal budget. It will increase the deficits. And so like I said, this is the year 2025 where you have to roll almost a third of the treasury debt, roll and sell a third of the current debt. And you still have a $1.8 trillion deficit being projected for this fiscal year. So I don't know. We'll see. So here you have the 30-year treasury. It's at the highest level in 14 months. So it's moving higher. If it breaks higher, what does that mean? Okay. Um, are people anticipating this? Are people paying attention to this? Again, is the market prepared to absorb all of this new debt? And what are the maturities that they're going to sell this debt at? Are they going to be able to sell the debt on the long end of the curve? Is it going to be able to absorb that much debt? Are they going to have to do it in short-term debt? Another reason I think that they cut interest rates wasn't necessarily because of the economy or anything, or they're so smart and they're getting ahead of the curve. I mean, the interest is killing us. We're over $1 trillion a year now. And so they know they have to roll this debt and they need to get rates down because now you're going to start locking in yields. Are they going to roll all this debt just on T-bills and short-term notes? I mean, that's, as Luke Gromen has said, and I've pointed out before, that's like kind of like a payday loan. That's how an emerging market operates. That's how these countries that have all kinds of issues, currency crises, and economic issues, that's how they deal with their debt. The debt has to be brought under control. And again, there's no constituency for it. No one wants anything really cut. And I've talked about this before, and I've said it before, and I know it's not going to happen. I qualify the statement before I make it. It's not going to happen. The things that are required to happen to fix this problem are not politically possible. Nobody would stand for it. If you cut like you need to cut, you'd have a massive recession, massive unemployment, the stock market would collapse, and the political power would shift away. And so it's easier to kick the can down the road and hope for the best. Do some tree trimming here and there, a little window dressing. Yeah, we cut 300 billion. We put a hiring freeze on. We did this, blah blah blah, and look what happened. It's not going to be sufficient. The only way that this gets solved is having a crisis that doesn't allow you to do anything else but solve the problem. And eventually that's going to happen. And, this is another big risk for this year. If rates move higher, they go to 5.5, 6%, as I've seen some people say. If that happens, I don't think you're going to have all-time highs in the stock market. Maybe you will, but I doubt it. So this was big news this week on the uranium front. And so I want to spend a little time on this. Um, this is the view from Canaccord, big brokerage and that does a lot of resource stocks in Canada. And so here's the update. Kazatomprom has notified the market of a temporary suspension of production from Block 1 of the Inkai joint venture, which is 15% of total Kazakh supply, effective 1 January 2025. Under the Subsoil Use Code, operations can only be conducted under an approved field development project. However, the company has not yet received these approvals due to delayed submission of the required documentation. The joint venture is expected to submit this documentation within the next couple of weeks. That's kind of what has happened. So this production, which Cameco is the joint venture partner with Kazatomprom on this particular block. Here's what Canaccord says about it. The company has noted that this is not expected to impact 2025 production plans. However, given that Block 1 is the only producing area within the joint venture and it has performed poorly, less than 80% of subsoil use levels through 2024, we are skeptical that this will be the case. However, we note that this is contingent on the speed with which the company can receive the requisite approvals. We continue to look towards early February for the next milestone for Kazatomprom and the broader market, when we expect 2025 guidance will be provided and come in lower than the 25,000 to 26,500 ton target. Overall, the news highlights the reality that supply risks continue globally, which should be positive for spot price your momentum in the new year. And so I'm supposed to believe. Now let me get this straight. I They shut down this production because somebody and some middle manager in government affairs department of Kazatomprom didn't file a form. Well, maybe that's what really happened. Or let's look at this possibility. Kazakhstan is under the it is tied because of its formal ties to Russia from the Soviet times, and China and the global South and East is looking at this and saying, you know, um, Kazatomprom is a state-owned company that has some of its shares trade in the open market, but it's still controlled by the Kazakh state. And so all the little things that are happening in the background that we don't know about, maybe it's been decided that why do we need to have Cameco as a joint venture partner in this? What if we, muscle them out somehow, and this is the beginning of that process? What if the government comes back and says, well, we got the form and we don't agree with this, or you haven't met your requirements, blah, 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 blah. I think also that there's some issues around the sulfuric acid. It's still been an issue there, and whether they can use sulfuric acid from Russia, which because of the sanctions and all these things, and it's just, maybe this is the beginning, the lighting of the fuse to eventually say, you know what, you're out, Cameco. And, you know, more of this geopolitical fallout as we see this bifurcation in this tit for tat for sanctions, and as part of this overall global struggle between the emerging uh, global South and East and the existing hegemon. What if that's the possibility? And this production just goes away. What's Cameco going to do? Fly to Astana with a couple of attorneys and have an arbitration in Kazakhstan? I mean, we could see where this might go. I'm not saying okay, that's the case. We don't know, but it wouldn't be beyond the pale if you're playing chess, okay? And how you could cripple the Western. I mean, this uranium, all the reactors are being built in the global South and East for the most part, and more of the supply is being locked up by the global South and East. Yet everybody now acknowledges and wants to increase their nuclear fleets. So this is an interesting development. It bears watching. I think this is interesting. Uh, Maybe this is all above board and it's just a bureaucratic error and they'll file the form and they'll turn everything back on and everything will be wonderful. Or maybe this is just the beginning of a setup to rug pull and get Western entities out of Kazakhstan. I mean, what are you going to do? They can make any decrees they want. There's nothing much you can do about it. So we'll see. I'm not, maybe Kazatomprom eventually just delists its stock and just renationalizes the company, and then we don't have to deal with the West anymore. I wouldn't be surprised if that happens down the line. So we don't know what the truth is. We don't know what's really going on. We do know that we have this overhang of conflict, which involves currencies, sanctions, economics, access to world markets that's going on between, basically Russia, China, and the BRICS. Uh, I mean, you have to pick a side. Kazakhstan has to decide. Some of these countries have to pick a side. Where's my future? I'm over here on the global island. I have Russia to the north, China to the east. My future lies with them, not, can't a Canadian company that really can't do anything about this anyways. Now they say in their press release, Kazatomprom, that they are going to fully, it's a typical corporate C-suite palbum that you would expect to hear. We're going to honor all of our contracts, yada, yada, yada. But we'll see. Um, this is a tremendous risk in my mind to uranium prices going higher. We're just seeing more and more. The hits just keep coming. And so I don't want to be engaged in hyperbole, but you can come up with a scenario where this could be the outcome. Again, it may just be some department in Kazatomprom didn't file the requisite forms. I mean, that seems a little stupid to me, but whatever. It's happened. I'm sure it's happened before, but we'll see. But I do think this is very interesting news, and I think it fits into the what this ongoing, what I call this low grade fever of World War III, a cold World War III that is going on that most people don't acknowledge is happening, and it is. And this is part of it, in my view. It could be part of it. So we'll see. Very interesting. And, with all the other problems that Kazatomprom has and the management problems, I mean, it's very possible that there's some kind of shicky-micky going on here. So speaking of Cameco, here is BMO Capital Markets. It's showing the expected cash flows for Cameco to explode over the next several years. You see here's cash flows and then free cash flow climbing uh, through the rest of the decade. A lot of people like to bag on Cameco, but I think that they've done a pretty good job managing themselves through this bull market, through this what's going on. Some people bag on them, but the stock, it's overvalued. It's tremendously overvalued. But I mean, personally, if I was running Cameco, I would use that overvalued stock to roll up some other properties, but that's me. But anyways, this is what the analysts are expecting, but we'll see. So here's another divergence for gold. Another reason why you may want to take a look at gold. This is like another historic uh, situation. We have gold miner free cash flow margin versus the GDX. you've seen as margin has increased in the past, uh, you know, we've seen the GDX perform. I mean, here we are, we're at 7.5 times free cash. We're tremendously undervalued relative to the gold prices, what I'm saying here. So, or relative to where GDX is. So, I mean, another example of a divergence that I think you could take advantage of. I think that we all know that gold stocks have underperformed the gold price, and I think that's going to continue until you see the bubblicious tech side eventually peak and then go into decline. I don't think you're going to see a move in like the gold stocks, a big move, and some of these other value areas until, I mean, it's just such a gravitational pull of capital into this FOMO bubble. These things just aren't going to get traction. But again, when they do, I think when they reverse, you have a tremendous amount of potential upside. And so here's another thing. I mean, grabbing this stuff off Twitter. This is the mining stocks versus tech stocks, but they don't really say it's like what are you comparing here? But I think it's just kind of interesting, the visual. That's what happened after the dot-com bubble crash, right? Mining stocks took off as tech stocks crashed, and then tech came back, and mining stocks went down. They've been basically out of favor for over a decade. Is it time to turn? Again, I watched these small cap and Canadian Venture Exchange index looks like it might be turning. We may be getting the initial indications that this is turning, but you see the potential. This is what I was talking about earlier when I was talking about Jeremy Grantham, as he was invested in value. And some of those value stocks were mining stocks back during the tech bubble. You see that the mining stocks outperformed as tech crashed. So we'll see. Um, History doesn't necessarily repeat exactly 100%, but it rhymes. And so I thought this was just an interesting visual to take into consideration. So this is interesting. This shows you the average retail price of electricity, monthly prices going back to 2002. The black lines are California, and the blue is the rest of the United States. And you see the divergence of California's electricity prices versus the rest of the U.S. Uh, we all know why that is because of the overregulation, the net zero, all these things are cumulative. And so we've seen this in Germany now, where it has the highest electricity prices in Europe. And now we see how that's affected the economy there. Now you showing you the high electricity prices in California because of the overregulation and poor policy making and emphasis on net zero. And so I think that, this is why I think that yes, California, I think its GDP is so large, it's probably like the seventh or eighth largest economy by itself in the world. But you can throw all this away if you, as Germany has, by inflicting stupid regulations on your economy. And you can you can cause yourself to you know, take away your advantages and give them away, and then your economic success will eventually decline also. And so that's what we're witnessing. These are two laboratories that we're watching of different ideas about different energy policies and what the pursuit of regulation and energy policy should be. And you see the outcomes. So, um, a cautionary tale, if you will. Okay, guys, that's it for this week. A little bit shorter, no political. I know some of the people are still on their fainting couches from last week. Nothing really big to talk about. Uh, Politically this week, a lot of people don't like it. But we're going to continue to talk about what we need to talk about, or what I think needs to be talked about. And I think that a lot of people do appreciate it. The channel continues to grow. I appreciate that. I appreciate the support. And we'll see. I think, like I said, this is the first show of 2025, and I think there's going to be a lot of risk and volatility this year. There's a lot of things that can happen, I think, this year that are going to be that have the potential to really affect markets tremendously. So we shall see what happens. We will watch as always, and we will be here every week commenting on it. Thanks for your support, and we'll talk to you next week.